Powell, when he said we got to move cautiously, like why not just end why taper? Why not just end the asset purchases? Well, we're going to be cautious. That means we're going to be behind the curve. We're not going to get in front of it. So if you're doing that on raising rates, that means inflation outpaces the rate hikes. That means negative or more negative real rates, which for the last 50 years has been bullish for gold and silver.
This week's specials with Miles Franklin Precious Metal Investments.
2021 Austrian Philharmonics for only $360 over spot. 2022 Noah's Ark silver coins, 1 ounce coins for $375 over spot, and 1/4 ounce coins for $245 over melt.
Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty in Finance, and back with us today is our good friend Lobo Tiggre from the Independent Speculator. Lobo, thank you so much for joining us today.
Thanks, Elijah. Happy to be back with you.
All right. Well, we definitely had a very interesting day yesterday. We're recording this on Thursday, the day after the Fed meeting and the Fed announcement of their double taper. Now, your perspective on this and how it impacted the markets.
Well, you don't need my perspective. Just look at the market's perspective. Clearly, markets went risk on. So the question really is sort of why. Now, the Fed did communicate, for better or for worse. It did a good job communicating this in advance. I think this was entirely as expected. If anything, I was wrong, I would say, in that I didn't think the Fed would come out as hawkish as the markets were expecting. The double taper, no question, and that was assumed. But on top of that, the 3+ rate hikes in 2022, I thought was more aggressive than the Fed would come out. Now, talk is cheap. The Fed hasn't done any rate hikes. The rates are still flat. The double taper doesn't tighten anything. It reduces the quantitative easing, but we're still easy. Before this tapering is done for next quarter, the Fed is still injecting liquidity into the system. So my interpretation is that since the expectations were so hawkish, I really thought there was a chance that the markets could actually respond positively if the Fed came out sounding dovish. And that doesn't mean dovish, but just not as hawkish as expected. So it came out as expected. So it's not quite what I thought, but it does seem like there was some fear out there that the Fed might respond even more aggressively on the inflation front. So two thoughts to put in here. One is there was an instant response, and then there was after a minute, if he's trading seconds, there was a different response. And I think you have the headline, and then you have the dot plot, which, by the way, is not in the same press release as the FOMC statement. You have to, dig a little deeper to get the dot plot. And what the dot plot shows, and this consensus of, we're going to raise rates in 2022, it's all 18 dots are looking at rate hikes in 2022. That's a big pivot. But then you look farther ahead, and instead of that being takeoff and we're going up and up to what are we at with inflation, 6%? Instead of that, it curves over right away. In 2024, they're looking at maybe 2.5%. That's well below current inflation rates. So, and so that I think was the not as hawkish as expected. People expected takeoff, and then so maybe, and I can't interview every trader in the world and know this, but my thinking is that they thought takeoff meant something more linear, and instead they got something that flattened out. So that was the initial response, and that wasn't good enough for gold and silver. That was fine for risk assets, but not gold and silver. And then Powell started talking. And I think what did it there was that, he was asked obviously about the rate hikes and so on and about inflation. And he admitted in a more open way than I thought that they got it wrong. This was not the inflation they were looking for. It's not the inflation they want. It's not based on this super robust growth. It's based on, they say it's all nothing to do with monetary policy, right? It had nothing to do with the money printing. Oh, it's all these supply chain disruptions. But whatever the reason for it, they're saying it's sticking around. So, that was an eye opener. And then when they asked about the rate hikes. And he said, well, those rate hikes assume a certain amount of growth. They're not written in stone. If we don't get that growth, we're not getting the rate hikes. So you've got Powell saying, on the one hand, we've got higher, more persistent inflation. Where have we heard that? And we have the rate hikes not written in stone, and they might not even happen. I think that's the environment that the gold traders were looking for. That suggests, more negative real rates for longer, perhaps even more deeply real rates. And that's what, for the last 50 years, gold has responded to. And again, this isn't you and I going down to Miles Franklin or the local coin shop or whatever. This is the futures contract traders who set the prices that we, I think, mistakenly call the price of gold and silver. That's what they look at. And they got what they look for. And today, as you and I speak, it's continuing. We're back almost at 1800. It's really quite striking as this, as the market has digested what the FOMC did and didn't decide.
You've been talking for a while about how inflation is not transitory. And actually now we got that, official statement from the Fed saying, yeah, actually it's not anymore. Your perspective on that and what we're going to see in the future, because you had been talking about stagflation. You were recently interviewed on the Deep Dive podcast, and you were talking about how it could be reflation instead of stagflation. So can you kind of distinguish the difference between those and and explain for our viewers what you're expecting?
I don't have a firm forecast here. I'm just basically admitting that I'm looking at the data, and it's not entirely what I expected either. So I don't claim to be perfect or to know the future. You know me, I hate making these bold predictions, or, I have to make forecasts. I have to project, but I don't like pretending I know what's going to happen. I know that the Fed will do this. They must do that. They have no, who knows? So what's happened is that there's real data now, credible data, that does look like more economic activity and strength in the U.S. at least than I expected. In Q3, it's funny, I just talked with Lynn Alden, and we were talking about this, and she agreed with me that Q3 looked quite stagflationary, and Q4 less so. Right? There's more signs of growth, so she sees what I'm thinking as well. And so what I'm putting on the table here, and my base case expectation is still for stagflation. I still see that the economy is not as robust as the powers that be want to say, or even just that Powell told us yesterday. We have this great economy. If it's so great, why is he still quantitative easy? Oh, well, we want to be cautious. Yeah, well, if the economy is really that great, yeah. Anyway, the point is, though, that it's possible that all this money printing, and remember, there's fiscal stimulus as well as the easy money, which is still easy, and that's still ongoing. Like, there haven't been any new stimmy checks, but the child credit is still ongoing, and it's significant, and it's direct cash into consumers, voters' pocketbooks, right? So that's still happening, and there's a possibility here that we do get a reflationary boom, and that means that we have this new growth cycle. It's not organic growth. It's not real, if you want. It's not because businesses and consumers or individuals saved and now they have the money to grow. It's new money coming into the system, creating new growth. And the growth is real, but it's not well targeted or directed because it's not natural to where capital would flow without government interference. So this is not my new prediction. My base case expectation is still for stagflation because things are still breaking. There are still shutdowns happening. And even though I think there's now a good chance that Omicron actually ends the COVID-19 situation, who knows? There could be another variant. And rightly or wrongly, we know the governments will react with extreme caution. So there could be more shutdowns, more economic damage. And the money printing is still going on. So my base case remains stagflation, but I'm saying there's actually a chance here that without more shutdowns or Omicron euphoria sets off, a new boom. And that becomes a reflationary boom instead of a stagflationary plateau. Don't know which way it'll go, Elijah. The so what's for that are the stagflationary environment is better for gold and silver. So for stackers out there, if I'm right about that, that would be the better news there. The reflationary environment, I think, is still good for anything real. Inflation is still high, so anything real still does well. but the fear factor goes away. The safe haven demand is reduced for gold and silver there. So it's less good for gold and silver than the stagflation environment would be. But both of them are great for commodities in general, industrial metals as well. You could see silver outperform gold because of its industrial side as well. But certainly, that would be better news for copper, nickel, iron, oil, everything else on the industrial side if we got that reflationary boom.
No, you've actually recently written about inflation in an article you had at the end of November. You said that essentially, as Milton Friedman said, inflation is always a monetary phenomenon. It's being blamed right now on the supply chain issues. But even if those are resolved, we're still going to see inflation. And ultimately, it's because the Fed is creating so much currency. Your perspective on that?
Yeah, several factors here. One thing to remember, and my critics will say, "Oh, but velocity of money is so low, and that's so it's keeping a lid." But actually, I think that's part of my case is that velocity of money is already low. Like if we had higher velocity of money and the monetary inflation wasn't resulting in price inflation, then you could have continued, monetary additions, but velocity of money could be reduced, and you could end up with flat consumer prices. But if you've got velocity of money already at or near record lows, and you've got the money, how low can the velocity of money go? There actually is a lower bound to that. You can't go lower than zero. There's an upper bound, but there is a lower bound. So with the velocity of money already low and people starting to think about inflation, consumer decisions, we already see it in the data. Expectations are higher in this velocity of money question. That matters. It's always and everywhere a monetary phenomenon with what's the other Friedman expression? Powell quoted it yesterday, something like unknown and of unknown duration and extent delays. It takes a while for the new money to percolate through the system and move the overall economy. The summary of the view here is I'm very much in the inflationary camp. You could have, if there's some new giant shutdown that just all the sphincters tighten again, you could have a temporary, not transitory, but brief flash of negative CPI like we saw last March. But that doesn't make anybody's life any cheaper. That doesn't change the trend. So I'm absolutely in the inflation camp. I think that the expectations could alter the velocity of money, which would actually turbocharge my expectations in the inflation camp. And even if there's no more money printing, what's already been done, those delays of unknown duration and extent, we'll see what that does. But I think our choices are inflation or inflation, and stagflation or reflationary boom. And all of these are good for commodities. As I say, somewhat different for gold and silver depending on how it goes.
No, with respect to gold and silver, we're seeing some predictions from major financial institutions that are very bearish for next year, like $1,600 gold.
Yeah, I saw those stories too, Elijah. And the thing is that these guys, these forecasters on Wall Street or Chicago, London, they have models that they base these things on. And I have questions about these models in the first place. As a fundamentalist, as a person who sees the physical metals as savings, as a real asset, not just a tradable, investment commodity, I have very serious issues with these models and the way they work. But besides that, we are in uncharted waters. We really, the world sailed into uncharted waters after 2008, but we've gone, way beyond the charts after the COVID-19 situation. So I think it's highly questionable how any of these models hold up and the assumptions that go into them in a world where we are now. It's beyond question. I just think they're wrong. I think some of them are just flat out wrong. And it's not reasonable to make the same assumptions in 2021 or 2020 that you might have made in 2018 or 2019. I think it's just wrong. Now, does that mean that gold's going to go back to 2000 next year and that it won't go down? No, I don't know. Nobody knows. I'm not God. I can't tell you what's going to happen. I do think gold goes back up over 2000 next year. There's a forward-looking statement for you. I can't tell you when or how much, but just the trend, the inflation that I see, I'm comfortable saying I think gold goes back up over 2000 over the next year, and I think we will see silver over 30 as well. We'll see if I'm right or I'm wrong about that. Could it go the other way? Sure. I just don't think the odds favor that. And I think the models that predict that are very dangerous to investors' financial well-being.
Now, in the article I mentioned earlier, you also mentioned how essentially after any sort of war, there's a change in government policy that kind of stays. And, we saw that after World War I, II, and we've seen this, the war on poverty, you mentioned the war on everything, and the war on now COVID. There's been different policy decisions, and people are wondering, when are things going to get back to normal? You say, no, this is kind of the new normal, especially when it comes to monetary policy. And we saw a major shift in 2008 and a major shift in 2020 with the COVID crisis. And that's kind of just the new normal for monetary policy.
I wouldn't say that it stays exactly where it is. The new normal will be figured out. But I do think it's a mistake to assume that, this is all just some giant aberration and things will go back to the way they were before. And I don't think that's much of a stretch. I mean, most people, you look at the financial talking heads. I'm a talking head right now, but you look at these guys on CNBC or whatever, and everybody's talking about how, going back to the office is not going to be the way it was before. And that business travel is not going to be the way it was before. I mean, it will grow back and there'll be new business travel. As the population grows, business travel may become bigger than it was before. But as a percentage of travel, it probably never goes back to the way it was before, because people have been shown that it's simply not necessary to get business done to travel, or certain businesses. For my business, I want to go kick the rocks when I'm investigating a mine or an exploration project. I want to talk to the locals and see if they're burning the CEO in effigy where the cameras don't see it, right? I want to get a feel for how things are in that very specific location, and travel is essential for that. But even, these $1 billion SPACs and things, you listen to these guys talk, they've raised this money via Zoom. If you can raise billions of dollars to launch a company via Zoom, what do you need to travel for? Maybe if you want to, it's a nice perk or something, but you don't have to. So the new normal isn't going to be what it was before. For us, as gold and silver monetary metals non-investors, I'm a saver in the bullion. I'm a speculator in the stock. There really isn't an investor in me in between. It's one or the other. But for us, what happens to monetary policy? I think, for one, these emergency tools that from 2008, they're not emergency tools anymore. They're normal. That's part of what I would see as the new normal. Like, anytime anything bad happens, they'll whip out these tools. Everything's an emergency. Nobody wants anything bad to ever happen. And I think one key one to focus on in terms of the new normal post-COVID, specifically the COVID, is that this COVID situation set in place what I think is a very dangerous precedent of a standard, a basis for policy being no fault of their own. Like, everybody got all these bailouts, companies, individuals, because through no fault of their own, COVID came along and whacked them. Okay, that's true. I'm not trying to say COVID was the average American housewife's fault. I'm not saying that at all. I'm saying there are a lot of bad things that happen. That's no fault of anybody's own. And we've got natural disasters right now. We've got storms, tornadoes. That's no fault of everybody's own. Everybody should be bailed out, obviously. Or you know what? A recession is not any one person's fault. Well, maybe it's the Fed's fault, but according to the powers that be, a recession just happens. It's nobody's fault. So basically, you can't have any recessions. It's nobody's fault. Therefore, everybody should be bailed out. I'm not predicting exactly what will happen, Elijah. I'm saying that this standard that has been set of no fault of anyone's own excuses any government largesse and excess to any degree, whatever it takes. Biden just said that when he went to Kentucky, whatever it takes. Well, so you combine no fault of anyone's own to whatever it takes, and there is no limit to government largesse. We're just in the process of raising the debt ceiling, 2.5 million. I mean, it's a ridiculous circus show. They might as well raise it to 50 trillion, or just get rid of it entirely. Because when bad things happen through no fault of anyone's own, got to bail them out.
Definitely. And at the end of the day, even if the Fed raises rates next year, you've pointed out what really matters is negative real interest rates for the precious metals.
Absolutely. I think we're actually setting up for a repeat of 2004, 2005, where the Fed was behind the curve, which is exactly what even the Fed apologists are saying now. And to some degree, the Fed Powell, when he said we're going to move cautiously, like why not just end why taper? Why not just end the asset purchases? Well, we're going to be cautious. That means we're going to be behind the curve. We're not going to get in front of it. So if you're doing that on raising rates, that means inflation outpaces the rate hikes. That means negative or more negative real rates, which for the last 50 years has been bullish for gold and silver.
If we can turn also to uranium, because I know you covered that quite a bit, and we have been seeing, quite a bit of a rise in the uranium price, and we're seeing, very interesting news from Sprott having their uranium physical trust and a lot of physical demand there for uranium. Your perspective on the uranium market right now?
Well, the main thing I'm actually going to say is very simply, happy news for those who missed the big Sprott push and all this rally that we saw this year, is that there is a correction now. Uranium's going back to the lower $40 range, and that has put a lot of the stocks under pressure. It's amazing how uranium went from being ignored to euphoria, woo, it's going to the moon, to now it's become hated again. It's almost as hated as gold again because it's not doing what people wanted it to do. People thought Sprott was going to take us directly to the moon, and we've paused for a correction and consolidation. Nothing goes. Trees don't grow to the sky, as they say. Nothing goes up forever. Uranium remains solidly above trend. It can correct another $10 without breaking the lower bound of the upward trend there. So I still like the uraniums. I still see the fundamentals as very strong. The BRICS countries are building plants gangbusters. The mines don't supply enough for the world now, as is, let alone the increasing demand for it. All these things have lined up. And then you got Sprott come in, and now Kazakhstan too, hoovering up all the cheap pounds. All of this, I think, is very bullish. I think corrections are very normal. And, it takes courage to buy when others are selling, Warren Buffett's statement. But I think that's where we're at now. We are looking at prices. The only stock right now left on my shopping list is a uranium stock. And I had a low entry price I wanted. And people told me, oh, it's 50% above that. You're never going to get that price. And we're close. We are close now. I might get filled on that. And there are other, really great, compelling uranium stories out there that are, much more on sale than uranium itself over the last just few weeks. So I know it's not everybody's cup of tea, Elijah, but for those who are interested or those who thought they missed it, this is the time to look. It's a 2 steps forward, 1 step back market. We're in that 1 step back. Word to the wise. Definitely.
And if people are interested in learning more about your analysis on uranium, precious metals, and the markets, where can they go?
Thanks for that. IndependentSpeculator.com is, of course, the place. I encourage everybody to sign up for our free weekly newsletter called the Speculator's Digest. And I do my best to be helpful, to educate. I answer questions from readers in there, and I do not spam them. If you sign up for the weekly digest, you get 1 email per week.
Lobo, once again, thank you so much for your time. God bless and Merry Christmas.
Thank you. Happy holidays to you.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.